ETFs are becoming more popular due to its convenience, cost-effectiveness, and diversity. As of June 2021, the US ETF market has grown from $2.6 trillion before the pandemic to $3.9 trillion. This is good news for investors who want to add more ETFs to their portfolios, and it suggests that more growth may be on the way. But what are the things you need to know before you start investing in ETFs? In the previous video of this two-part series, we talked about what exactly is an ETF, how to choose the best ETFs to invest in, and how to find the ETFs you want to invest in according to your goals. In this video, we'll dive further into ETF profiles, fund overlap, portfolio tilt, portfolio correlation, and dividends. Welcome to Knowledge Pilot. When you're looking into ETFs to invest in, you'll find that most, if not all of them, have something called an ETF profile. So let's say you like an ETF and you want to invest in it. But first, you want to look up the ETF profile to learn a little bit more about it. How would you find the answer? Go to google.com and type in the name of the ETF. So, if SPY is the ETF you want to learn more about, you would type SPY ETF. When you hit enter, the ETF should be the first link on the list after the ads. If you click on that link, you'll be taken to the SPY ETF profile. You're going to need to know some of the basic terms that are often used on an ETF profile. Now, every ETF from every company like Invesco, iShares, or Vanguard will have its own profile. The profiles will look different, but the information on them will be the same for the most part. Fund summary or overview. You should invest in ETFs that fit with your investment strategy and what you are trying to do. First, you should look at the fund summary or overview. It has all the information you need about the ETF. Most of the info will be in bullet points. Overall, this section will tell you a lot about what you are about to buy. If you read that section and it didn't match up with your investing goals, you don't need to look at the rest of the ETF profile to know that it won't help you reach your goals. This is the list of important factors to consider, and we will get into the details of each one now. Number 1. Expense ratio. Next, you should look at the expense ratio to find out how much it will cost you to own the ETF. The expense ratio can be thought of as the management fee. For example, the expense ratio for SPY is 0.09%. That means that if you put $1,000 into SPY, you'll only have to pay 90 cents a year on that $1,000. You should pay attention to the expense ratio, and if it's too high, try to find another ETF, since there are so many out there. You should always keep an eye on the expense ratio since it can really cut into your profit over time. Number 2. Returns. Another very important thing to look at will be how well the ETF does. You want an ETF that gives you the kind of return you're looking for. If you want to invest in ETFs for the long term, you should look at the return over a long period of time, like the 10-year return. The market sector and largest holdings sections of the ETF profile are also important to look at. The distributions should be the next and last place you look. The distributions are the dividend payments you get for owning shares of the ETF. If you don't know what a dividend is, we'll explain it a little bit later in the video. Number 3. Fund overlap and diversification. How do you avoid what's known as fund overlap? You might not even know what fund overlap is or if it applies to you, but it does, and it could hurt the long-term growth of your portfolio. Fund overlap is when two or more of the ETFs in your portfolio invest in the same stocks or stocks in the same sector. You should look at two different ETFs. Say, for example, that you have money in both VOO and VTI. Well, it just so happens that 99% of the stocks in VOO are also in VTI. Investing in both VOO and VTI is a perfect example of fund overlap. It's bad to have funds that overlap because it takes away from the benefits of having a diversified portfolio. You can do more research using the Fund Overlap tool in the ETF Research Center, www.etfrc.com. Why is it important to have a diversified portfolio? Well, it is one way to protect your investments against the roller coaster swings up and down of individual stocks. For example, instead of investing your entire portfolio in Microsoft stock, you could invest in VOO, which is an ETF that invests in the entire S&P 500 index, which includes over 500 stocks, including Microsoft. If your entire portfolio is invested in Microsoft, the growth of your portfolio will depend entirely on the growth of Microsoft. which may not seem like a bad idea right now, but no one knows what the future will bring. Microsoft could go out of business tomorrow and just like that, wipe out your entire portfolio. But by investing in ETFs that hold hundreds of different stocks, you limit the possibility of the inevitable roller coaster volatility within your portfolio. Number 4. Portfolio tilt. What is portfolio tilt? This is when you bias or tilt your portfolio on purpose in one direction or the other. For example, if you wanted your portfolio to be most exposed to the technology sector of the stock market, you would want to invest in more than one ETF with overlap in the tech sector. But in general, portfolio overlap should be avoided by most people who just want a well-balanced portfolio that grows steadily with the least amount of risk. Number 5. Portfolio correlation. So, we just talked about how portfolios can overlap and how they can tilt. Now, you should know more about something called portfolio correlation. Diversifying your portfolio across different stocks and stock market sectors is one thing. But some investors think you should also pay attention to what is called portfolio correlation. Correlation is a way to measure how stocks, bonds, and ETFs move in relation to each other. If one goes up or down, does the other one also go up or down? Or do they move in opposite directions? Or do they move in ways that have nothing to do with each other? When one goes up, the other one goes the other way, down. The correlation coefficient is a formula that sounds very hard to understand. It shows the relationship between two things. Basically, this formula looks at stocks, bonds, ETFs, and other investments and gives them a number between -1 and +1 that shows how well they are doing. When the prices of two or more securities tend to move in the same direction, they are said to be correlated. How closely correlated they are will determine where they fall on a scale from 0 to 1. When securities move in opposite directions, they have a negative correlation that ranges from 0 to -1, depending on how uncorrelated they are. If you want to get the most out of your diversification when you invest in ETFs, you should not only invest in a wide range of stocks through ETFs, but also in a wide range of stocks and other assets that are not closely related, like stocks and real estate. You are looking for a positive but low correlation number. Number 6. ETF dividends and DRIP. Now let's talk about ETF dividends and DRIP for a moment. The letters DRIP stand for Dividend Reinvestment Plan, which will make a lot more sense in a moment. A dividend is when a company pays you money for owning shares of its stock. If you own an ETF like SPY, which holds over 500 stocks, it's likely that some of those stocks pay dividends, and you'll get paid those dividends through the ETF. The dividends will get deposited into your brokerage account, but it just sits there as cash, doing nothing. To prevent your dividends from doing nothing, you can set up a dividend reinvestment plan, a DRIP. This is when you earn a dividend through your ETF, and it is automatically reinvested back into buying more shares of the ETF. This cycle of your dividends being reinvested into more ETF purchases will result in exponential growth of your wealth over time. This is the effect of compound growth. We are not going to talk about how to set up DRIP with your broker, but if you go to Google and type in the name of your broker followed by the letters DRIP, you should see a help article that shows you how to do it. So now that you know everything there is to know about ETFs, so how do you buy your first one? How to buy your first ETF. First, if you haven't already, you should open a free brokerage account. You want to invest as much money as possible, and you want to keep putting more money into your brokerage account every month and every year. This way, you can take advantage of the stock market's compound growth and build your wealth in a very safe and consistent manner. This video is just your first step towards investing in your first exchange-traded fund. We hope you enjoy the content of this video, and we thank you for watching.